Let's connect with Rajeev Thakkar, CIO with Park Mutual Fund to understand what his take of the market is. Rajeev, fantastic to have you back. Thank you for joining us. Rajeev, first let's start with the selling in Nasdaq. You got large exposure to some of the FANG stocks. Now we can look back and say, look, they've had a crazy move, so what they're correcting. But have they made a top for multiple years? And if they have, how will you do? What will you do with your global portfolio?
Okay, so I'll break up these stocks into two categories. One was a set of stocks where there was hope trade, where a new world and everything will be digital, and these are disruptive companies and future is good and no earnings right now, sometimes even no revenues, but the idea looks promising. And essentially the ARC stocks, if I were to call them, where a huge set of companies just went up multiple times, whereas reported earnings and revenues were not keeping pace. So over there, the drawdowns have been to the extent of 50, 60, 70%. Some stocks are down 90% from the highs. Obviously, the top has been made, and to recover back to the previous levels, it will take a lot of effort. The other set of companies is the more mature tech space, which even earlier were valued normally in terms of as a multiple of cash flow or some sort of a DCF analysis or something like that, and where prior to the fall they were reasonably priced. After the fall, they are attractively priced. So I think they will take this in the stride and again go back to the highs or even beyond. So from our end, there's nothing significantly different that we are doing as compared to what we were earlier.
So you don't think there is a reason why one should shift focus away from global stocks and back to Indian stocks? Because the way Nasdaq has fallen and versus Indian markets are outperforming, you have the option. I mean, you can sell those stocks and come to India. Would you be doing that?
We would not be doing that. So typically, we are people who would add if stocks have fallen significantly and valuations are attractive, rather than do reverse. So we are not people who would increase allocation to a market which has done well over the past 6 months and reduce allocation to market which has fallen in the last 6 months. We would typically be doing the reverse. But in the current scenario, we are capped at the amount which we can invest in foreign stocks, and the mutual fund industry is capped at in terms of their foreign investments. So incrementally, we are buying only Indian stocks, but we are not looking to sell foreign stocks and invest that money into India.
Okay, Rajeev, so that's exactly what I wanted to ask, because at a personal level as well, you have exposure to Nasdaq stocks in your own funds. In the recent decline, have you added more positions?
So we could not after 1st or 2nd of February, or 3rd February, whatever was the date. So the mutual fund industry as a whole reached the $7 billion outward remittance limit that has been set by the RBI. And because of that, every fund house was instructed not to increase positions in foreign stocks. So for the last couple of months, we have not been increasing allocations to foreign stocks.
Right. Interesting. Rajeev, intrigued to know that, the fall in the US equities has not only been restricted to Nasdaq. Much like India, US equities have fallen more. So outside of the list of the tech names in the US, where else have you added positions, if at all?
We have not added much.
Okay.
So we obviously have the option of reshuffling our portfolio, which would involve selling some of our existing positions to buy something new in the US. That is permissible, but we have stuck to the positions that we have. And we have had minor purchases on account of the dividend received on the foreign stocks. But we have not added any new name in the foreign portfolio.
Rajeev, what should be the construct of the portfolio now, considering that IT has peaked out, you've invested in mid-cap IT stocks, you made good gains for your unit holders in the mid-cap IT. Is it time now to start thinking outside the comfort of Persistent or, some of the other bellwether names?
Yes. So the mid-cap IT positions that we had earlier, things like Persistent and Mphasis and all, given the very high valuations, we have exited those mid-cap IT positions. Uh, you are right. So one needs to look at the overall market and figure out where attractive valuation opportunities lie, rather than just stick to the sectors which have been comfortable in the past or which give these warm and fuzzy feelings. So one has to look at opportunities where they lie. So as I see it currently, banks have been oversold, especially the private sector banks. And in that space, in a rising interest scenario, people with good current account, saving account balances, where they have this share of low cost deposits, we will see them increasing their net interest margins. Also, the results that have come out, we have clearly seen the credit costs moderating for these banks, where the huge NPA provisions and all are a thing of the past, and people are bouncing back very significantly. So, well-run private sector banks would be a space I would look at, and maybe selectively PSU banks may also be good investments, but we are sticking with private sector banks for now. Some of the traditional energy companies may offer value. So, given this huge thrust towards renewables and ESG and all that, we have seen underinvestment in traditional energy companies, and in the current scenario, we are seeing power shortages, and we are seeing people scrambling for oil, people scrambling for gas, coal, all sorts of things. So even that could offer investment opportunities. And I think for many years now, we have been avoiding PSU stocks given the governance issues. But clearly one is seeing some movement in terms of either complete privatization or listing of some of the public sector undertakings, and then improving the governance. So we are watching that space as well.
Interesting. Rajeev, I'm sure you, like many of us, must have logged on to hear out Warren Buffett and Charlie Munger. Tell me what stands out for you. I mean, for me, besides their views on Bitcoin, etc., which are already known, was that insurance is a fascinating business. And they said that, you know, they should teach auto insurance in business schools now. So sniffing off some opportunity, I guess, that they've spotted.
Yeah, so on the auto insurance space, it was actually in response to a question on Progressive and Berkshire's Geico and state-run insurance companies and the mutual insurance companies and things like that. So he said that it is very interesting that something which in theory should not work, where private sector should be taking market share and mutual insurance company should not be that large. He said it's interesting that the largest insurance company is a mutual in that sense. For me, what stood out very significantly in the meeting, and these were not just comments made by Warren Buffett and Charlie Munger, these were also comments coming in from the CEOs of various Berkshire companies, and that pertained to inflation. The traditional narrative has been that the current inflation is driven by supply side challenges, the supply chain shocks, the Russia-Ukraine war and things like that. Whereas in all the conversations of the CEOs and the comments made by Warren Buffett from the stage, they indicated that it's clearly linked to the demand and the monetary and fiscal stimulus that was given. They gave examples of furniture stores seeing huge demand, and even if prices are increased, shoppers are still buying, people are buying jewelry. So that was one end of the demand equation. And on the other side, in terms of even wage cost, they clearly mentioned that it's a challenge to hire and retain people, and they are having to increase the remuneration very significantly in order to staff their stores and factories and things like that. So these were very interesting comments, and which flies in the face of all the central banks who have been saying it's a temporary situation and we should just wait it out.
Okay. Where are markets? I mean, they've frankly not really fallen down a lot. I think that is clearly evident. But Apple, Meta, Amazon, some of these stocks have literally gone to the cleaner. There was a specific mention on how Wall Street has, in a sense, fueled what could be called as a gambling culture. And specifically, Mr. Buffett was referring to the day traders and how some of the new age apps, in a sense, are promoting day trading. The cycle has reversed. Day trading is down, volumes are down, stock like Robinhood is down 80-85%. What does that mean? How should one apply that indication or that red flag from Buffett?
Yeah, that was actually part of various comments that were made with regard to various trends in the financial markets. He mentioned that how he was able to buy between 10 and 15% of a large company in the US within a matter of 11 days. So I think he bought 14% in 11 days or something like that. And which is kind of tough to believe because typically you would expect shareholders to buy and hold for the longer term, and only some shares would trade in the market at the margin. So he said that was indicative of short-termism. And a related question was there on passive investing and how some three large passive fund managers effectively control the corporate policies, and they are able to vote on significant matters, and they may not even be tracking those companies because they are just supposed to follow the index. And so far things have been fine where passive funds are just north of 50%, but if it went up to, let's say, 75-80%, then how it would impact corporate America and things like that. So they were clearly very concerned with the day trading and short-termism in the market, the derivative volumes, and the complete disconnect between the fundamentals of the company and how people are buying and selling those companies.
Sure. So, Rajeev, given the kind of churn that one has seen in India in terms of a sectoral rotation playing out, we have fallen in line with the US, but not fallen as much. Wanted to understand what is it that you've been doing in your India portfolio right now? Anywhere that you've added positions, cut positions, or maintained status quo, or at least keeping on your radar to add whenever?
Yeah, so we have cut positions in the last 3 to 4 months in the Midcap IT. We are completely out of Midcap IT. We have been adding positions in private sector banks. So especially post the merger announcement of HDFC Limited and HDFC Bank. And the current quarter results have been very, very encouraging for a whole set of banking companies. And in a rising interest rate scenario, we would see them benefiting. We have added the coal company, Coal India Limited, in our tax saver fund and then some of the hybrid funds. So that's been largely the stance.
Rajeev, really appreciate your time. So glad you could join us, and certainly hope to see much more of you going forward.